Welcome back.
Hi.
This week we're going to talk about different loan programs, what they entail, what you need for them, and how I can best utilize them for you.
Yes.
Let's get into the different types of loans. Three main ones that we're going to go over, and I'm going to let Melissa go over them.
Yay! Okay, so your catch-all is conventional. This is just a home loan. It's basically a house loan. So whatever lender you're at, they have their own kind of restrictions, I guess, and programs that they utilize within conventional. It's kind of the catch-all for everything that's not government, basically.
Yeah.
They're unique, definitely, to each lender. They're not for people with credit troubles or somebody with like a lot of debt. They're harder to get into because they have some pretty hard stops. I know some lenders won't mess with anybody if you have a credit score below 700. You know,
tight.
That's a big ask,
tight,
right?
Yeah.
That's not necessarily everybody, and that cuts out a lot of people. And the down payment can be kind of anything from 3% down if you're a first-time home buyer and you qualify for this, all the way up to, depending on how many units the property you're buying has, all the way up to 20-25%. And everything in between. Sometimes you don't qualify with a 3% down, even if you're a first-time home buyer, right? Sometimes you don't qualify if you're putting 5%. It just kind of depends on the risk level that you are as a whole buyer.
Yeah, I've heard you've called me before, being like, well, they qualify conventional with 15% down.
Yeah,
I'm like, ooh, okay,
exactly,
that's fine.
And that could be because of the property. Like maybe it has nothing necessarily to do with them, but it's because you're buying a manufactured home, or a condo or whatever. There are different properties that carry different risk levels, and so the lender can decide, okay, with manufactured homes, I'm going to require a minimum of 10% down.
Yeah,
they're allowed to do that.
Yeah, and with the risk factor, that plays into the PMI a little bit, and so PMI is mortgage insurance, and with conventional loans, it falls off at 20%.
Yep, when you are at a 20% equity position, which means you have paid off about 20% of the value of the home.
Okay.
Right. So when you have 80% left, it'll automatically drop off because they legally have to. Lenders would keep it on there forever if they could, but they cannot. So it has to legally drop off after you've paid down 20%. Cool. So you can get to that position, fairly quickly if you put down a large down, right? If you put 10-15% down, you'll get there pretty fast.
On the realtor side, we don't have nearly as many restrictions when looking for homes with conventional. Is like that catch-all that we were talking about at the very beginning. With the other government loan programs, we have a lot more restrictions for the safe and soundness of a home. So that will play into the next two loan programs that we talk about. The next one's FHA.
Yes. So this is a government program, and we'll just give a brief history because I
like history.
Love the history of FHA. So this program came about because conventional loans that was it, right? And so they could make you put 10% down, 20% down. They could say no loan for you because your credit score is this. Nope, no to you because of that. Well, FHA came in and made it to where basically anybody can get a home loan, right? Because they have a flat minimum investment. It's 3.5% down, period. Yeah. Whether you're buying a 1-unit property or a 4-unit property, 3.5% is it for all buyers.
Yeah.
They have a much more flexible credit score minimum. Typically, we see about 580 is kind of the minimum that you can get away with. Obviously, better score is better for everybody. But but if that's where you're at, then that's where you're at. FHA program might be the one for you if you've got some credit trouble. And the catch is that the MI, you do have the MI, just like with conventional, but that's on there for the life of the loan.
Yeah, and that it does add quite a bit of money to your monthly payment. I usually see it around, like, honestly, it depends on the price of the property, but
right, it's a percentage.
It's a percentage,
and it's a flat percentage, right?
But it still ends up being, I mean, unless it's a condo, it's under $100,000.
Yeah.
I mean, you're still looking at $100 a month.
Yeah,
like roughly.
Not necessarily cheap. And the other thing to kind of notate with respect to conventional FHA is that your mortgage insurance for conventional is dependent on how risky you are, right? Mm-hmm. So your mortgage insurance may be really cheap if you've got really good credit, your debt to income ratio is low, you know, you're not a risky borrower to the lender. Whereas FHA is the same for everybody. It's this percent, and that's what it is. So it doesn't matter if you're a 580 or an 800 credit score, you have the same mortgage insurance.
And that is a nice equal playing field.
Yeah, it is.
It makes everything equal.
What's cool about the history of it is that it equalized the playing field. It made it to where anybody could, you know, could
utilize it.
Could buy a home. Because there were so many people that were left out that there was nothing wrong with them. They just they messed up once and then that, you know, goodbye. Or the lender just decided that they wanted 10% down for that, you know, for them because that's what they wanted, you know, like.
And they have a little bit lower of the interest rates typically than conventional does.
Yeah. FHA tends to, because it's a federally insured program. So that MI that you pay into for FHA, it goes into a pool at the Federal Housing Administration, and that is the guarantee, the insurance for the lender.
Okay, yeah.
So when the lender lends out the money, if you were to default with FHA comes in and takes care of lender.
Everything.
Right.
Yeah. So
it's a more secure loan, and so therefore you get a better interest rate. You just do. It's a less risky person.
Less risky, but does your credit score, your risk factors, your
Those
DTI
still go into it.
Yeah, your DTI and your credit score are like your
they still
two
matter.
big ones.
Yeah, they still do matter for sure.
Okay, just wanted to make sure.
Yeah. They're not as important in the FHA program itself, but FHA as a whole gets you do get better.
Yeah.
A slightly better interest rate. But you got that MI forever.
Forever.
It's forever.
The loan that I'm probably most familiar with, just because of the location I'm in, we have the Army post and the Air Force base within 30 miles of each other.
Yep.
And then, you know, so I am very used to the VA loans.
Yeah.
They are a great loan program.
It is the best.
It is.
Such a good program. I love that this exists.
Yeah, it's a good way to give back to the veterans.
Yes, they earned it.
They did. Yeah, they did.
You know?
Yeah, they did.
100%.
I'm not going out and battling.
Legit
So.
earned this thing. Give them a home.
Yes.
So VA. This one is for veterans or active duty service members. Anybody who has the benefits.
Yeah.
Can go get a house. It is a 0 down program. Caveat: you do have to pay for your closing costs, unless you get a seller credit, which Nicole can talk all about because she's
seller credits.
Very good at getting a seller credit on a contract to have the seller pay for your closing costs. But you cannot finance closing costs into the loan.
That's across the board for any loan type.
For all of them, yes.
Anything. That is what you bring to the closing table to buy the house. Yeah.
You cannot do that. The cool thing about them is that you don't have to invest anything. So you don't have to put anything towards the principal of the loan as some skin in the game for you.
Yeah, I love a good seller credit. We'll come back to that at the very end because I want to talk about seller credits.
Yes.
For each different loan type. There's a different amount that I can get for you. And I want to go into that. But back to the VA. Okay. I love VA. There's so many fun things about it.
The other side of the VA program is it does have a funding fee. And something to keep in mind. This, however, is financed into the loan.
Yeah.
So you don't pay for that up front. You don't pay for that at closing or out of pocket anywhere. It's just part of the loan. So what you want to think about is if you have the ability to put a down payment and you're going VA, I always recommend you do, because that when you put a down payment, towards VA, that funding fee reduces substantially. And so if you think about it, if you're putting zero down, you're getting this funding fee financed into the loan. You start off upside down.
Mm-hmm. And when you look at an amortization chart, or when you put a breakdown of all 30 years of your loan, you get this when you close. It shows what you pay to principal and what you're paying in interest. And because what you pay off in interest is so little in the first 3 years, that sometimes the gap really isn't that big when you turn around to sell in another PCS season.
Right.
So it is something that I really like to bring up to my VA clients, like pay attention to what your funding fee is. Also, let's talk about VA funding fees your second time around.
Right. And so, yeah, exactly. So that percentage, so it's a percentage of the purchase price. That's what it is. And it's a designated percentages. If it's your very first time, if it's your very first time and you put down 5%, it's a different amount. If it's your very first time and you put down 10%, it's a different amount. Now, subsequent use is a whole nother ball game. So after you've used your VA benefits one time, you are then subject to subsequent use funding fee percentages.
What does that mean to
and
the 22?
Those are higher. So they go up, right?
Yeah.
So instead of being 2%, it's 3.3 for a subsequent use for the funding fee. And if you put down 5%, it's a lower amount. 10%, it's an even lower amount. But subsequent use is pretty expensive. Subsequent use and you putting down 0% is 3.3% of the loan amount.
Yeah, what is subsequent use to the 22-year-old military soldier that?
So that means that you've already bought a home and used your benefits.
Okay.
So even if you have sold it and you don't own it no more, or whatever happened, you don't own it, doesn't matter. You've already used it for once. And so your first time is used and now you are subject to subsequent use.
Okay.
Forever.
And is that funding fee, is it different because you can have VA loans open on different homes?
Yes.
You can
absolutely can.
State to state it difference on the amount, right?
Correct.
Okay.
Yes.
Yeah.
So wherever you're buying, that's what limit you are subject to.
Okay.
So
we have a pretty high one.
Alaska is very high.
Yeah.
It's a little over $1 million.
Yeah.
And so if you own a home over in Maine and it's worth, you bought it for $250,000, you got plenty of entitlement left to come up here and buy a very nice house.
Yeah.
There's no problem about that. Even if you keep that one, you can totally keep that other house, and you can have as many houses as you want, truly, as long as you have enough entitlement to buy again.
Yeah.
And where you're buying matters.
Yes.
If you're going over there, so if you bought in Alaska and you go down to, I don't know, Arkansas, where they have a much lower, Texas or whatever, where there's a much lower limit, then you're subject to whatever those limits are down there.
And I'm assuming that's also based off of like property values in the areas. Yeah. We have, our property values are fairly, I wouldn't say they're like the highest. I mean, we're not in like New York or like California and stuff like that, but cost of living is not cheap here.
Cost of living is high.
That's really what it comes down to for our homes and why they're so expensive.
Right.
But one more thing to touch on with the VA loan, you can utilize it in multiple ways or multiple times. Government loans are not meant for you to utilize to build a real estate empire, but you can with your VA loan. Hear me out, please. You can start in a fourplex. In 1 year, you have to occupy for 1 year. We can start your home search again to then go to a triplex. I need 2 reasons. I need 2. That's it. It can be the year. It can be the construction. It can be the location. If there's a garage, do you need an extra bedroom? We are creative.
Location.
We are so creative and we can do it. And I've done it.
School systems.
All the things.
You have to have a good reason of why you need to buy a new property in the same area. But you can do it.
And then you can go from that triplex 1 year later into a duplex. And then you can work your way into a single family home. It is not common, and it is very hard to go from a duplex to a triplex or triplex fourplex. Yeah, it is possible.
Going that way is much harder.
It's possible. I've done it. It's not easy. Don't recommend.
No.
But it is something that, we don't have a lot of fourplexes and triplexes available in our market. So when they come available, it makes sense for people to want to jump on them. So making sure that that triplex or fourplex in the area has substantial, reason for you to move into something, because they're going to instantly red flag you and be like, why are you trying to take advantage of me? It's like, why are you trying to do that? But I can, and I will take advantage of it. And
it is possible.
Yeah, it's possible.
It's definitely possible.
It's just hard.
And it's
not
best,
ideal.
So it's best to think about these things before you buy. What is it that you want to do? If you're wanting to own a multifamily and utilize your VA benefits, you should buy that first. Yeah. You should 100% buy that first, because once you own a single family home, what reason could there be for you needing a fourplex to live in? Yeah, there really isn't, because you're moving from a whole house, a whole 4 walls that are yours, into an apartment.
Now here's a question that I just thought of.
That's tough, because you got to have a good reason. It's called a motivation. What's your motivation?
Is divorce motivation?
Divorce is motivation.
That is very morbid, but it was just a thought. Because what if they had
a family change of some kind? Yeah, all of these things, can't. It's the why. It's about the why, and it's got to be good.
I can make a good reason.
It's got to be good. Yeah,
I can make a good reason.
We're good at delivering the reason appropriately, but there's got to be a good one to start off with.
Yeah, and it makes sense too, in a sense of we don't want it.
It's not a program that's meant for you to build this book of business. That's not what it's for. And so there's little catches out there and gotchas to prevent that. But we know what they are.
Yeah. And we can take care of that.
So we can massage them around it. But yeah. It's a thing. It's definitely a thing. Yeah, don't think you're limited because you need to utilize the VA program. Like you can do some cool stuff with it. Yeah.
My last thing is the seller credits. I'll start, because we just ended with VA. So I'll start with VA. I can use up to 4% of the purchase price in seller credits. Typically what I've seen across the board with most lenders is your closing costs are going to be anywhere from 2.5% to 3.5% of the purchase price, very dependent on your lender. Did you buy down interest rate? Did you do all these little things? That's going to depend what your closing costs are. So I can still use, even if they are really high, and you did have, say, roughly around 3.5% of our closing costs, I still have 0.5% to play with. Now, these are for closing costs, prorations, prepaids, and other lender allowable expensive sale. A prepaid could be, we could start a fuel account for you at Sourdough Fuel and prepay that money into that fuel account. Done it before, done it twice actually.
Yeah, I've seen it.
And so it's like little things like that. What is the worst thing that can happen? A seller is going to say, no, I don't want to give you that much money. How many times have you been told no? By the time you're like 2 years old, you've heard it some like astronomical amount of times. You're used to hearing
it's all you hear.
It's all you hear. Exactly. And so what's the worst they can do? They're going to say no, and they're going to counter you. Yeah. They're not going to just, they might just say no, we're not going to do anything.
Seller credit queen.
I love seller credits. So it's like,
she gets to pay for all kinds of stuff.
It's so fun. FHA is my favorite loan program to play with for seller credits, because I can get up to 6%. Do you know what that does for you?
Yeah.
That opens up so much for you. Not like you're going to use all of them, but we can buy down your interest rate. That's very time dependent on like what's going on in the market. Would you recommend buying down your interest rate right now? That can be something we talk about next week or something,
Yeah.
Because with rates coming down, like, is that going to make a lot of sense right now? That's something for a different time. But anyways, there's just so much to play with that I love to do. And then conventional, that one has a little bit more variables to it, as you've noticed in this video. There's variables. Investments, it's 2%. I think that's what we did for our one client.
Yep.
And then up to, what was it? 3%.
3% for just a standard single family.
Again, that's still
residence.
Most of, if not all of your closing costs.
You can typically get them all covered.
Get them all covered. That's my favorite thing to do. It's all, in my opinion, it's all about, for what people are seeing. So a little psychology that happens. They see you're not coming in asking for a bunch of closing costs. And also asking for $20,000 off the purchase price. We're not in that time frame anymore. Also, just putting that out there. But talk to your lender. What is $5,000 off the purchase price going to matter more to you on your monthly payment than getting $5,000 in seller credits instead?
I mean, $5,000 spread out over 30 years is pennies. You know,
pennies.
It's a drop in the bucket when you look at it. Your payment's gonna be this much lower versus a $5,000 seller credit now. I mean, who doesn't want to have $5 extra grand in their, in their account right now to not have to pay for your closing costs? But I want to be clear on this: you cannot use seller credit towards your minimum investment.
Yes, it cannot be used for.
It cannot go towards your down payment at all. That is not allowed.
That is 100% your thing. You got to bring down.
If you're FHA and you bring 3.5%, period.
Yeah,
no matter what seller credit you have on there.
Unless you have a gift of funds, but that's a different conversation for a different time.
Right.
That'll be an assets video. We're gonna get into that. But cool. I think we covered pretty much everything that we wanted to on the loan program side of things.
Yeah, I think so.
Cool. All right, that's it. We'll talk to you later. Bye.